The fire alarm that didn't ring. It starts as a routine operation. A standard morning liquidity ad, the kind markets ignore. Dealers submit bids, a little elevated but nothing dramatic. Then the clock runs, 5 minutes turn to 20, the size isn't announced. Phones that never stop buzzing go quiet. One repo desk head texts arrival, "You seeing this?" The reply takes too long. That's when traders begin pulling lines, not because they know but because they don't. Why it matters is simple. When the backstop hesitates, the price is built on that backstop wobble. Every mortgage, every swap, every bond priced off the smooth flow of funding suddenly looks like it's standing on glass. Collateral that traded yesterday at a small discount needs a bigger haircut today. Basis spreads, normally boring, start to breathe like panic. On the official channel, the phrase is policy transmission frictions. It sounds tidy. Inside the pits, it feels like collateral scarcity dressed in a suit. There are bills, there are notes, there are bonds, but the specific pieces everyone needs to finance positions are stuck. Specials go more special. General collateral drifts above policy. The overnight reverse repo facility pulls like a magnet while dealers beg the right CUSIPs to cover shorts. No one wants to say it, but the market's map of safe assets just shrank mid-session. Meanwhile, pension risk officers who sleep near their phones sit up. A margin email hits at 3:18 a.m. local time for a fund that promised steady returns. The finance chief calls the Treasury desk, who calls their clearing broker, who's already raising haircuts because their prime brokers are raising haircuts because their banks are watching their leverage constraints. You can feel the cascade before you see it on screens. What nobody saw was the dependence tucked at the core, maturity transformation hiding in plain sight. The institutions we call long-term were financing long with short pipes, counting on the smoothness of the backstop to roll forever. Every day is yesterday until it is. When the curve shifts and liquidity thins, small funding mismatches turn into job-threatening gaps. That's when lines get yanked, not because someone's insolvent, but because the pipes can't carry the load at today's speed. On one desk, a basis trader had the perfect hedge. Long cash bonds, short futures, carry paid by a few basis points, leverage multiplying the boring into a business. It works when repo is a utility. It unravels when specialness spikes and the special you need can't be borrowed at any price that keeps the math whole. He hits reduce, but the street is doing the same trade and the exits narrow. The phones that fall silent tell you more than the calls that get through. A senior repo trader keeps a mental list of who blinks first in every past scare. He dials 2 names. Voicemail. He tries a junior who answers with a clipped "We're flat." Translation: "We're done extending." At a clearing bank, an internal dashboard shows fails ticking up, first tens of billions, then more, while a compliance window flashes alerts about concentration. Officially, nothing's wrong. Unofficially, desks start pricing, and what if the operation doesn't show? Another 10 minutes pass. One bank's Treasury desk pulls back from term quotes. The price for certainty jumps, haircuts, those quiet percentages in footnotes move a notch, then 2. Value at risk models, tuned to recent calm, begin thinning inventories because the model says this is not the day to be heroic. Here's the whisper no one writes down: central banks are dealers now. The facilities designed to support market functioning have become the market for last resort. When they hesitate, it's not a signal, it's a vacuum. Dealers whose balance sheets are capped by leverage rules can't suddenly double their capacity. They won't. So market depth collapses faster than the headlines can form. Behind the glass, a policy team watches spread monitors, not just inflation charts. The choice is ugly. Step in, widen collateral eligibility, and confirm that the market depends on you. Or wait and risk a bigger break that forces you to do the same thing at scale with more stigma and less time. Someone argues the rulebook. Someone else says, "We'll rewrite it if we have to." To understand the silence, we need to go back to the blueprint. The part written when emergency playbooks from 2008 to 2012 turned into permanent architecture. Balance sheets became policy tools, and pipes were replumbed in ways that made the system smoother, until stress demanded the old flexibility from a market that had handed it away. But before we rewind, stay with that room for one more moment. The head of funding for a mid-sized insurer tries to borrow against sovereigns that were considered pristine last quarter. The screen flashes a higher add-on. He looks at his calendar of liability payments and knows he can meet everything if he can roll today. He calls a relationship banker who says carefully, "We're reviewing limits." He doesn't shout, he writes down the time. The fire alarm didn't ring, it stuttered. And in markets built on the idea that the alarm always works, a stutter is enough to move billions, to change careers, to set off hedges that weren't supposed to matter. The backstop is still there, it always is. But the hesitation revealed the truth. The system's calm depends on collateral that's scarcer than the speeches admit, and leverage arranged around the assumption that the fire station never burns. The blueprint: how a backstop became the market. To understand the silence, we go back to the moment the manuals changed. After 2008, what started as emergency improvisation turned into architecture. Central banks didn't just cut rates, they re-engineered the pipes. Facilities with sunset dates got extensions. Acronyms that sounded temporary became household names on trading floors. The lesson markets learned wasn't subtle. The referee could step onto the field and play the ball. Here's the hinge. Before the crisis, balance sheets were signals. After, they became instruments. Quantitative easing wasn't a headline about cheaper mortgages, it was a plumbing job. The central bank bought duration from the market and replaced it with reserves. To the public, that looked like stimulus. Inside the pipes, it changed who held what and how funding moved. Duration left private balance sheets. Reserves swelled at banks that didn't need them for lending but needed them for regulation. When you flood banks with reserves but remove swathes of safe collateral from circulation, something subtle shifts. Private dealers who used to intermediate flow and warehouse risk now face a different balance sheet math under tighter leverage rules. Their capacity to absorb shock shrinks. Meanwhile, the demand for pristine collateral rises because margining regimes ask for it, regulators prefer it, and every model assumes it trades like water. The loop tightens, reserves up, safe collateral down, intermediation thinner. Quantitative tightening tried to reverse it, but not symmetrically. You can drain reserves, sure, but the market's habit has already changed. Participants who rebuilt their strategies around abundant backstops and predictable pipes don't pivot overnight. Hedge funds built basis trades that relied on smooth repo. Pensions and insurers hedged duration in ways that required rolling collateral day after day. Banks, constrained by leverage rather than risk-weight, rationed balance sheet space. The capacity that left didn't simply return with a press release. Meanwhile, something else happened in plain sight. The market functioning mandate widened quietly. In 2008, purchases came with the language of panic. By 2012, they arrived with phrases about transmission and functioning. In 2020, the language carried an implicit promise. If functioning slips, we'll step in across asset classes. Not permanently, they said, just until stability returns. But each step changed expectations. The line between lender of last resort and dealer of last resort blurred. This mirrored what BIS quarterly reviews later dissected as market functioning interventions across sovereigns and credit, and what the Federal Reserve's own 2020-2021 facility reports framed as temporary operations to preserve transmission under extreme stress. Get this, policy communications started targeting plumbing, not just pricing. A speech about tapering could widen mortgage spreads if dealers believed inventory would pile up. An offhand remark about technical factors could move repo rates more than a full meeting's decision. The market wasn't listening for the old signals. It was listening for clues about pipes, collateral, and balance sheet elasticity. Every sentence became a forward guide to liquidity conditions. There was also a moral hazard migration. Classic bank risk boxed in by capital and liquidity rules bled into non-banks. But the funding pipes didn't change nationality, they still ran through banks, clearinghouses, and collateral chains anchored in the same sovereigns. The risk shifted venue, not system. A hedge fund's leverage might be private, but its financing lives in the same repo markets that a dealer taps, which live under the same central bank umbrella. The map looked diversified. The pipes weren't. The result? 3 structural cracks formed while everyone pointed at inflation, growth, and unemployment. First, collateral scarcity tucked inside abundant reserves, an illusion of plenty with the wrong kind of plenty, a pattern highlighted in BIS work on safe asset scarcity and repo market segmentation. Second, leverage where supervisors didn't have direct line of sight, interacting with margin models that assumed liquidity, a recurring theme in FSB non-bank financial intermediation assessments and IMF global financial stability reports. Third, fiscal realities pressing into monetary plumbing via issuance patterns that dealers had to digest with balance sheets. They no longer had echoing Fed staff analyses of SLRG, SIB constraints, and primary dealer capacity. Each crack was rational, each step defensible, each memo clean. Together, they made the system brittle. Look at the timeline. Emergency lending facilities in 2008, asset purchases scaling in 2009, forward guidance mixing with balance sheet policy by 2011. Sovereign stresses in Europe forged a template for market functioning interventions beyond banks. In 2013, a taper tantrum reminded the street that communication itself was a tool with teeth. By 2019, standing-like features appeared in repo to smooth spikes. In 2020, everything accelerated. Corporate credit backstops, municipal support, foreign swap lines expanded. Each program aimed at functioning. Each one widened the doorway. Language changed too. Transitory support became ensure market functioning. Then support financial stability entered routine statements, not just crisis minutes. That shift mattered more than 100 basis points. It told traders there was a line, but the line moved with functioning, a word flexible enough to fit the moment. The mandate in practice grew teeth where the market needed them. Collateral eligibility broadened, maturities lengthened, haircuts softened, until the day they tried to normalize. Here's the quiet irony. Normalization preserved the architecture. Even as purchases slowed or reversed, the presence stayed. A standing repo facility signals capacity. A daily balance sheet report becomes a market data point. Dealers model their limits around what the central bank might absorb or accept. Risk officers write policies with clauses that reference facility access if available. Nobody intends dependence. Dependence is the sum of thousands of rational policies written after the same shock. Now the psychological hinge. Temporary became a comfort word that trained behavior. A junior policy analyst drafts a memo with 3 phrases: temporary, targeted, technical, because that's how you get a green light. A senior trader reads those words and relaxes inventory because that's how you keep your job. A risk officer adds a footnote: facility access if available, because that's how you pass committee. Every time the word shows up, someone takes a little more flexibility for granted. The habit sets like concrete. Inside rooms with no cameras, the tension is personal. One governor stares at a depth monitor that looks thin and says, "We can't let this slip." Another points to a statute and says, "We can't live here forever." A lawyer taps a clause about functioning and says, "We can for now." The decision lands in the same place: act now, define later. It's not conspiracy, just humans choosing the least career-risky path in a system that rewards immediate calm. So when a morning operation runs long and the line goes quiet, the fear isn't abstract. It's the realization that the backstop became the market through years of well-meaning carpentry. The blueprint replaced wood with steel, removed doors, widened others, and labeled it temporary. Then everyone moved their furniture to fit. Now when the hinges squeak, it isn't about rates. It's about architecture. And architecture, once lived in, doesn't revert without breaking something people care about. Crack 1: Collateral scarcity and the Repo Choke. Here's where the pipes tighten. On paper, there's trillions in sovereign debt outstanding. In practice, the pieces that matter: on-the-run bills, specific notes, the CUSIP's hedges are built around, can vanish at the exact moment everyone needs them. When that happens, funding costs detach from the policy rate like a boat slipping its moorings. Your central bank can say 5.25% all day. If the collateral you need goes scarce, your true price is whatever gets you that piece tonight. The tug-of-war starts with bills and the overnight reverse repo facility. Money funds love the certainty of ONRRP, pristine counterparty, clean collateral exposure, no balance sheet surprises. Dealers, meanwhile, need those same bills to finance shorts and hedge inventories. When the ONRRP rate sits just attractive enough, cash migrates into the facility instead of into dealer repo. That pulls lendable cash away from the street, right when specials are getting tighter. General collateral inches above policy, then specials rip. Specialness sounds quaint until it blows a hole in your model. A particular 2-year note goes from -30 basis points to -200 against GC. If you're short that note as part of a basis hedge, you either find it or you pay through the nose. Fails start creeping up. First it's a rounding error, then settlements miss in size that makes risk officers sit up. The fails charge, designed to keep the system honest, becomes a real line item. People stop rolling term because tomorrow looks worse than today. Dealers used to lean into this. They'd warehouse inventory, make markets, and smooth the spikes. Now leverage constraints cap their balance sheets in a way that ignores how safe the assets are. SLR, GSIB buffers, internal risk budgets, pick your acronym, the result is the same. Capacity doesn't expand just because spreads do. So depth thins, a 3-tick market becomes a one-sided screen. Quotes show, then disappear. If you need a bid, it's smaller. If you need an offer, it's gone. Meanwhile, the basis trade, the industry's quiet workhorse, relies on those smooth pipes. Long the cash bond, short the future, clip the basis, funded in repo, lever it enough to matter. It's a utility trade when funding is stable and specials are tame. But the second specialness spikes, your carry turns negative. Haircuts widen as clearing brokers protect themselves, and the leverage you used to make pennies look like dollars flips on you. The math that made sense at -20 collapses at -180. Here's a human moment. A mid-level basis trader sits with a spreadsheet he's trusted for 5 years. He's got liquidity ladders, term funding, counterparty diversification. He's not reckless. He was told this is as close to risk-free as the sell side gets. Then the CUSIP he needs goes no offer. His prime calls, haircuts up 2 points across the book. He has collateral, but not the right collateral, and the wrong kind costs him time he doesn't have. He trims size. The market trims with him, prices gap. Now layer in settlement mechanics. Fails concentrate in the most used hedging benchmarks. Clearing agents flag counterparties. A few big players pull back from term trades, pushing more volume into overnight, which magnifies the daily scramble. General collateral prints above policy in the morning, then collapses in the afternoon when the facility reopens and window dressing kicks in. Volatility in the plumbing leaks into volatility in spreads. Basis moves no one hedged for start showing up in P&L that was supposed to be boring. Central bank facilities drift into the frame. The standing repo facility meant as a ceiling looks like a lifeline, but stigma isn't gone, it just hides better. Banks weigh optics against opportunity, and not everyone can access the window directly. So intermediation bifurcates, those with direct lines price one way, those without pay up. The facility becomes a de facto dealer. Its rate sets the top, its eligibility list defines what money-like means this week. That subtle signal reshapes balance sheets in real time. The Fed's Standing Repo Facility (SRF), formalized in 2021, and counterpart arrangements abroad were explicitly characterized as backstops for money market functioning, not as primary funding sources. Yet their mere presence influences private pricing, as BIS and Fed notes have observed. Here's what nobody wants to state plainly. The ONRRP grabbed cash precisely when the street needed it, and it did so by offering the safest collateral alternative in town: none. Money funds exchange cash for a claim on the central bank, not for bills that can lubricate trades. That's policy design, not malice, but the consequence is real. The more comfortable cash feels at the facility, the less patient it feels with dealers. The equilibrium tilts towards scarcity, not flow. And when scarcity bites, haircuts become policy. A 2-point change on a supposedly pristine bond is a tax on leverage. That tax cascades. Prime brokers widen further to shield themselves from client fails. Clients dump liquid to fund a liquid. Dealers starved of balance sheet step back. Futures decouple from cash. The ARB isn't an ARB, it's a liquidity bet dressed up as math. Everyone knows the central bank could ease the choke by lending the right CUSIP or widening eligibility. Everyone also knows the price of that fix: deeper dependence. Meanwhile, general collateral's drift above policy starts to matter for real borrowers. Mortgage REITs funding costs that don't match the speeches. Corporates rolling CP notice bid-ask moving in ways their treasurers haven't had to explain since the pandemic. The transmission mechanism bends. It still works, money is money, but it's delivering a different message. Availability beats price, and the definition of availability is shrinking to what the pipes can carry today. The crack isn't theoretical. It's a structural mismatch between abundant reserves and scarce collateral, policed by leverage rules that don't flex in panic and amplified by facilities that siphon cash from the street. In calm, that looks like safety. Under stress, it looks like a choke. And once you felt it, you don't forget. You short maturities, you hoard the on-the-runs, you pay up for certainty that used to be free. That's how a basis point problem becomes a system problem, quietly, then all at once. Crack 2: non-bank leverage that regulators don't see in time. While funding tightened in the pipes, a second crack grew in the shadows. It lives where mandates meet math: pensions, insurers, hedge funds, institutions built to be patient, forced by rules and promises to play duration games with short-term tools. On paper, they're strong. In practice, they're leveraged to collateral liquidity that disappears the moment screens turn red, and when it disappears, the fear isn't theoretical, it's a timer. Start with pensions. They promised liabilities decades out, so they hedged rates with derivatives rather than dumping cash into bonds. That's liability-driven investment, LDI. It works when collateral is easy. You post gilts, receive the rate hedge, keep the asset mix you like. As yields rise, your hedge loses value and the clearinghouse asks for cash variation margin. Normally, you raise it by repoing more gilts. In a squeeze, repo haircuts jump, specials tighten, and the cash you expected to borrow at a whisper now screams. The request says by close. The clock on the email is the scariest number on the screen. Here's the play-by-play everyone pretends was a one-off. Yields start marching higher. Gilt futures gap. Margin calls hit inboxes before breakfast. Pensions sell the most liquid thing they own, more gilts to raise cash. Selling pushes yields higher, which triggers more margin, which forces more selling. Prime brokers lift haircuts mid-spiral to protect themselves. Clearing members start asking who their clients' are. The spiral tightens until the central bank buys for functioning. The language avoids the word bailout. The effect is the same. The lesson is worse. Everyone now knows the panic clock can force a sovereign to blink. The FSB and BIS postmortems on the 2022 UK LDI episode documented this procyclical margin dynamic and the necessity of temporary gilt purchases to restore functioning. Insurers run a cousin of the same strategy. They hold long assets against long liabilities, but they manage capital with derivatives and collateral schedules that assume markets will take their collateral at known haircuts. Their models, solid and calm, imply liquidity on demand. When the special they pledged as high-quality liquid asset turns special in the wrong direction, their internal liquidity ladders suddenly have missing rungs. They're solvent. They just can't post what the system wants at 2 p.m. today. The fear isn't default, it's delay, and delay is punished like guilt. Hedge funds, meanwhile, are the system's shock absorbers until they aren't. Basis trades in rates, credit index tranches against ETF baskets, curve steepeners funded in rolling repo, all leverage small edges into meaningful returns. Risk is managed daily, sometimes hourly, through prime brokers who can pull financing faster than any bank regulator can call a meeting. The oversight is indirect. Margin models, counterparty limits, disclosure with a lag. When volatility spikes in the plumbing, these desks become forced sellers of the liquid to protect the illiquid. Funding calls arrive as terse bullet points. The subtext is panic. Margining models sit at the center. They're calibrated on recent realized volatility and liquidity assumptions that treat collateral haircuts as slow-moving. Under stress, liquidity becomes discontinuous. The model says post 20% more. The market says also your posted collateral is worth less at our desk right now. That wedge is where spirals start. It's not fraud. It's a timing mismatch with a megaphone. The psychology is simple. Pay now to avoid a worse email at 3:58 p.m. Now remember the LDI shock's final act. The central bank stepped in and bought long gilts to restore market functioning, promising sales later, limiting size, and setting an end date. It worked. It also taught a lesson. If a non-bank margin spiral threatens core rates markets, the dealer of last resort extends beyond banks. That embeds moral hazard. You can design better liquidity buffers. You can still model your strategy around the assumption that in extremis, the referee will play the ball again. Everyone denies dependence. Everyone budgets for it. Here's a human moment to ground it. A pension CIO watches yields tick through levels that were stress scenarios on last year's slide deck. He calls his LDI manager. How much? The number isn't ruinous, but the timing is brutal. Cash by close. They sell a liquid credit ETF because it trades tight. The ETF price gaps wider than the underlying bonds because the ETF is the only place you can get size now. Members won't see this screen, but their fund just paid for time. He stares at the timestamp on the margin email and writes it down next to the word never again, knowing he'll be back here. Non-banks don't live off the grid, they live at the end of the same pipes. Their leverage is funded by banks and brokers. Their collateral is evaluated with the same models. Their margin calls flow through clearinghouses that were built to be safe by demanding cash now. Regulators see parts of it in quarterly reports, stress tests, filings that describe risk at a distance. What they don't see in time is the intraday slide from manageable to mandatory, the missing 2 hours between tight and tap everything. And it's not just one country's quirk. Similar structures exist across USD, EUR, and JPY markets with local twists. In the dollar world, credit ETFs and TRS desks tie together retail liquidity and institutional leverage. In Europe, pension hedging and insurer solvency regimes create procyclical demand for high-quality collateral at the worst moment. In Japan, yield curve control shapes collateral availability in ways that suppress volatility until it returns in a rush, spilling into cross-currency funding as investors hedge FX with swaps that widen under stress. The hidden debt is everywhere. It's just booked as promises that assume tomorrow's repo works like yesterday's. Meanwhile, swap lines wait in the background for a dollar squeeze, but they're not designed for a non-bank margin cascade. They ease bank funding. They don't write variation margin checks for a fund in London holding Danish mortgages funded against euro collateral. The relief routes are diagonal, not direct. That lag matters in a world where a prime broker's email can change the size of a balance sheet in an hour. The gap between authority and need is measured in hours, not policy cycles. IMF and BIS analyses of dollar funding stress repeatedly note that central bank swap lines stabilize bank balance sheets, but reach non-banks only indirectly via intermediaries. So the second crack is clear. Leverage that lives in mandates, hedge the duration, target the spread, financed by pipes that demand perfect collateral in a system where the backstop signaled it will stabilize functioning even if the trouble starts outside banks. It's stable until a small miss becomes a system-level margin call. And when it comes, the call isn't answered by a press conference. It's answered by whoever can meet cash today, and by whoever learned to fear the timestamp more than the headline.